All right, today we're going to break down the timeless wisdom from Benjamin Graham's absolute masterpiece, The Intelligent Investor. Now, this isn't some get-rich-quick book. It's a guide to building a really solid way of thinking about investing, a framework that's held up for almost 100 years. Let's dive in and see how it can totally change the way you look at the market. So, Graham kicks things off with a pretty shocking idea. He says the biggest risks you face when you're investing don't come from the market or the economy or some slick broker. Nope, they come from inside you. This whole book is really built around one powerful idea: getting a handle on your own emotions. That's the real key to financial success. So, who is the guy behind these big ideas? Well, Benjamin Graham wasn't just some author or a theorist. You see, he was a guide, and his incredible insights were earned the hard way, through some really tough personal and financial times. And look, there's a reason his wisdom is so legendary. His most famous student, you might have heard of him, Warren Buffett, read this book when he was just 19. To this day, he still calls it the best book on investing ever written. I mean, that's pretty much the best endorsement you could ever ask for, right? You know, what's so powerful about this is that it shows Graham's principles weren't dreamed up in some comfortable university office. He actually lived through poverty. He saw his own family get completely wiped out by speculating in the market, and he personally survived the Great Crash. So these rules he came up with, they weren't just theories. No, they were straight-up survival strategies, born in the fire of real-world financial meltdowns. All right, let's dive into his first big principle. Graham was convinced that the very first thing you have to do is understand the huge difference between investing and speculating. The problem is, most people think they're doing one when they're actually really doing the other. Graham's definition of a real investment is super specific. It has 3 parts. First up, you gotta do your homework. Thorough analysis, as he puts it. You need to understand the business. Second, it has to promise safety of principal, which means your number one goal is not to lose your money. And third, you're looking for an adequate return, not trying to hit some unbelievable home run every time. And this just makes the difference so clear. The investor is digging in, analyzing what a business is actually worth. The speculator, they're just gambling on which way the price ticker is going to move. An investor protects themselves from big losses, while the speculator just follows the herd. And this is the big one. When the market tanks, the investor sees a buying opportunity, while the speculator totally panics. It really forces you to ask yourself, which one are you? Okay, this next part brings us to maybe Graham's most famous idea ever. It's this brilliant little mental tool for dealing with the market's crazy mood swings. He calls it the story of Mr. Market. So the big question is, when you see prices flying up one day and then just crashing the next, what are you supposed to do? What's the smart move? Well, Graham answers that with a simple story. I want you to imagine you own a piece of a business, and you have a partner named Mr. Market. And every single day, without fail, he shows up and offers to either buy you out or sell you his share. The only problem? Your partner is, well, a total manic depressive. So some days, he wakes up on top of the world, completely euphoric, and he'll offer you an insane price for your shares, way more than they're worth. But then other days, he's just convinced the world is ending. He's totally pessimistic, and I'll offer to sell you his shares for just pennies on the dollar. And here's the absolute key to the whole thing. You never have to trade with him. You can completely ignore his crazy offers. His mood is his problem, not yours. You are totally free to just wait until he offers you a price that actually makes sense for you. This quote just nails it. Mr. Market's moods aren't a threat to you, they're an opportunity. You use his pessimism to your advantage and buy stocks cheap. And you use his crazy optimism as your chance to sell at a great price. You're letting his foolishness serve your goals, not letting it infect your own thinking. So how do you know for sure when Mr. Market is offering you a real bargain? Well, that brings us to Graham's third and maybe most important principle. He called it the central concept of investment, the margin of safety. Think of the margin of safety as your buffer, your financial cushion. It's just the gap between what a business is actually worth, what he called its intrinsic value, and the price you pay for it. The bigger that gap, the safer you are. Let's make this super simple. Say you do your research and you figure out a share of a business is fundamentally worth exactly $1. But then your old buddy, Mr. Market, shows up, having a really bad day, and he offers to sell it to you for just 67 cents. See that 33-cent difference? That is your margin of safety. It's the cushion that protects you if you messed something up in your analysis, or if the company just hits a patch of bad luck. It's what keeps your money safe. And what this does for you is huge. When you have a big margin of safety, you don't need a crystal ball to predict the future. It basically absorbs your mistakes or any bad news. You don't have to be perfect to get a good result. You just have to be disciplined enough to demand that bargain price. And all of this leads to what is maybe the most freeing, most liberating idea in the entire book. Being a successful investor has very little to do with being the smartest person in the room. It's just like Buffett says, you don't need a crazy high IQ. What you do need is a solid game plan, which Graham gives you, and then the discipline, the emotional control, to actually stick with it. Being a genius without that discipline can actually be a huge disadvantage in the market. And if you need proof, look no further than Sir Isaac Newton, literally one of the smartest human beings who ever lived. He got sucked into a massive stock bubble. He actually sold early and made a nice profit, but then he got FOMO. He watched his friends getting even richer, jumped back in right at the very top, and lost everything. It just goes to show you being a genius is absolutely no defense against the madness of the crowd. And that brings us right back to the beginning. This is what Graham really meant by an intelligent investor. He wasn't talking about being clever or having a high IQ. He was talking about your character. It's about being disciplined, being patient, and being humble enough to know your own limits. So, here's the bottom line, the ultimate takeaway from it all. How your investments do is so much less important than how you behave. Your behavior is the number one thing that will determine your results. Graham gives you the tools, he gives you the framework, but the final question he leaves us with isn't really about the market at all. It's about you. How are you going to behave?